Welcome back to our fourth video in the series. In today's video, we'll be discussing the importance of accounting to business stakeholders. If you're new to accounting or looking to expand your knowledge, this video is for you. Financial decisions are crucial to any business, and stakeholders rely on unbiased, relevant, and timely financial information to make sound decisions. Stakeholders include stockholders, creditors, governmental and regulatory agencies, customers, management, and other employees. This video will discuss these stakeholder groups and explain how accounting is vital in their decision-making processes. Stockholders are owners of a business, representing an ownership interest. They use financial information to assess the business's performance and make decisions, such as purchasing or selling stock, and maintaining the current level of stock ownership. Stockholders focus on profitability, expected increases in stock value, and corporate stability. They analyze financial statements, such as balance sheets, income statements, and cash flow statements, to gauge a company's financial health and make informed investment decisions. Additionally, stockholders closely monitor dividend payments and stock price trends to evaluate the return on their investment. They may also participate in shareholder meetings and vote on corporate matters, such as board member elections and significant business decisions, based on their understanding of the company's financial position and prospects. In this table, we compare publicly held companies to privately held companies. Publicly held companies are those whose stock is available to the general public, and whose financial information is public. On the other hand, privately held companies are those whose stock is not available to the general public, and their financial information is private. Publicly held companies are typically larger in value, while privately held companies are generally smaller. The distinction between publicly and privately held companies is important for investors. It can affect the level of access to information about the company, and the amount of control they have over its operations. Creditors and lenders also use financial information to make decisions, specifically regarding the repayment of funds. They assess repayment risk, and use historical accounting information to determine the likelihood of repayment, which helps them decide how much money to lend, the duration of the loan, and the interest rate. In addition, lenders review a company's financial statements and ratios to evaluate its creditworthiness and overall financial stability. Moreover, creditors and lenders pay attention to a company's cash flow, assets, and liabilities to ensure that it has sufficient resources to repay debts. They may also require borrowers to meet certain financial covenants or conditions, such as maintaining a specific debt-to-equity ratio or achieving a minimum level of profitability. In doing so, creditors and lenders protect their interests and minimize the risk of default. In the context of business, a creditor is a business that grants extended payment terms to other businesses. This means that if Business A buys goods or services from Business B may allow Business A to pay for those goods or services later. This is common in business-to-business transactions, and is often necessary to help businesses manage their cash flow. On the other hand, a lender is typically a bank or other institution that lends money to businesses or individuals. This means that the lender provides the borrower with a sum of money that the borrower must repay over time, typically with interest. Lending is often used by businesses to finance operations or make investments. The key difference between a creditor and a lender is the time frame of the transaction. Creditors typically grant extended payment terms that are shorter than the time frame for a loan, which is usually longer. Additionally, while a creditor generally is another business, a lender is typically a financial institution. Understanding the difference between these two terms is essential for companies seeking to manage their cash flow and secure financing for their operations. Businesses have three ways to raise capital: profitable operations, selling ownership, equity financing, and borrowing from lenders, debt financing. Each option has advantages and disadvantages, which businesses must carefully consider when seeking funds for their projects. Profitable operations involve generating revenue by selling goods and services, which can be reinvested into the business to fund growth and expansion. This method is advantageous as it doesn't dilute ownership or incur additional debt. However, relying solely on profits can limit a company's growth potential, especially if it faces significant competition or operates in a slow-growing industry. Equity financing involves selling ownership stakes in the company, typically through issuing shares. This method can provide a substantial influx of capital without the obligation to repay the funds. However, it may dilute existing shareholders' ownership, and issuing shares can be expensive and time-consuming. Debt financing involves borrowing money from lenders like banks or other financial institutions. This method can provide quick access to funds and, unlike equity financing, does not dilute ownership. However, it requires businesses to make regular interest payments and repay the principal amount within a specified time frame, which can create financial stress if the company encounters difficulties. Governmental and regulatory agencies, such as the Securities and Exchange Commission, SEC, use financial information to protect the public interest by ensuring financial information is prepared according to the relevant rules and practices. They also work to ensure funds are used efficiently and transparently. These agencies establish and enforce accounting standards, such as the Generally Accepted Accounting Principles, GAAP, in the United States, to promote consistency and reliability in financial reporting. In addition, they monitor publicly traded companies and require them to submit periodic financial reports, which helps maintain a fair and transparent market environment for investors. In cases where companies are found to have violated securities laws or engaged in fraudulent activities, regulatory agencies can take enforcement actions, such as levying fines, imposing sanctions, or initiating legal proceedings. By doing so, they aim to maintain investor confidence and uphold the integrity of financial markets. End users and business customers are vested in a company's financial success. Financially successful businesses can provide better products and services, improve facilities, and contribute to a thriving community. End-user customers benefit from a company's financial success as it may lead to lower prices, higher quality products, and better customer service. In addition, a financially stable company is more likely to invest in research and development, which can result in innovative products and services that meet customer needs. Business customers, such as suppliers and distributors, also benefit from the financial success of their partners. A financially strong business will likely maintain long-term relationships, pay timely invoices, and invest in mutually beneficial collaborations. This can lead to increased business opportunities and growth for both parties. Employees, including managers, are strongly interested in their organization's financial performance. They rely on financial information to make day-to-day and long-term decisions, and to evaluate job security, promotional opportunities, and compensation considerations. Managers use financial data to assess the performance of various departments, allocate resources, and make strategic decisions that drive growth and profitability. Employees may also be incentivized through performance-based bonuses or stock options directly tied to the company's financial performance. Furthermore, a company's financial health can impact employee morale and job satisfaction. Financially stable companies are more likely to provide competitive salaries, comprehensive benefits, and opportunities for career advancement, which can help attract and retain top talent. As we've seen, accounting plays a vital role in the decision-making process for various stakeholders. Therefore, a solid understanding of accounting principles and financial information is crucial to making informed decisions that can impact the success and stability of a business. We hope this video has helped you understand the importance of accounting to business stakeholders. And as always, if you have any questions or thoughts, please leave them in the comments below. Thank you for joining us today, and stay tuned for more informative videos in our accounting series.